Closing costs. What are they in a real estate transaction? Who pays? And negotiability. Let's discuss these many items. I know it's a mouthful, but if I want to discuss closing costs, it's not a simple topic, and most people are very confused about how this works. So I thought I should take this video on priority. So closing costs are paid at the time of closing, like buying or selling a property, for all the types of services that are paid. So let's first start with what are closing costs. So there are two types of closing costs. One are non-recurring closing costs. That is, they are paid only one time when the sale is made, like title insurance. It's paid only one time. Escrow fees, that's paid only one time. County transfer tax, that's paid only one time. So these are the real closing costs. But apart from these, there is prorations or non-recurring closing costs. And the non-recurring closing costs are insurance. When you are transferring a property in a community that has an HOA, you have the HOA transfer costs and the HOA fees that are prorated. And then the property taxes are also prorated based on the date on which the transfer happens. Additionally, when you close on a certain date, the lender takes all the interest and until the date of closing, if based on a formula, and the lender will then charge that also to the closing cost. So all of these in the second block that I just mentioned, like lender interest proration, insurance, these are not closing costs, but still this money has to come to the table. And so you have to prepare the amount of cash that you bring to close as a function of non-recurring and recurring closing costs, both put together. So I hope I have clarified the difference between non-recurring closing costs and recurring closing costs. Why are they called recurring closing costs? Because insurance, HOA, property taxes, home warranty if you choose to have it, all of these will continue to happen even after you have closed escrow. But title insurance, escrow fees, county transfer tax, these are only one time, and in some cities there is city transfer tax, and San Jose and LA San Jose has the Measure tax and LA has the mansion tax. So these are paid only when the sale or purchase is happening. You don't pay that every month. So that's the difference between non-recurring and recurring. So let's get that clear. Now, let's talk about the non-recurring closing cost. In the non-recurring closing cost, the first is the mortgage. The lender charges for application fees, credit report, processing, appraisal, and underwriting, all of those. And sometimes they charge you origination. But remember, the lender's fees are a function of what they can absorb in the interest rate. So when a lender funds, what they do is they put it as an upfront cost to close the loan, so that even if you refinance tomorrow, all of this upfront cost stays with them. And they charge you interest rate. So a lot of times how the lenders work their complete transaction out is, they could potentially charge you nothing upfront, but they will load that into your interest rate. So if that loan is long enough, 30 years or something, this lower the origination number, it gets spread over the life of the loan. And if the interest rate doesn't go down, you're not going to pay that money back to the lender. So always remember this point, that there is a negotiability on the origination, the fees, the underwriting fees, the appraisal. All of these could be paid by the lender. What does that mean is, they are not paying it out of their pocket. What they do is they put it on your APR, they add it to your interest rate. So they'll adjust the interest rate to be slightly higher and reduce this or increase this based on what. So what should be your strategy, optimal strategy to adjust the interest rate and the lender's closing fees? The way you should adjust that is, if you see that the rates are going to go down and you are going to refinance, increase the upfront cost or increase the credit. Take that money into your pocket and you can let the lender increase their interest. Now suppose the risk there is that if the interest rate keeps going up like it has been doing over these last few years, the lender is going to benefit by continuing to charge you higher interest rate, and they will recover their money that way. But if the interest rate goes down from here, then you already took the credit for the closing costs, and that credit is sitting in your pocket. Even though you pay that slightly higher interest rate, once the rate drops, you refinance and you come out of it. It's a very smart strategy. Think about it and you will know. In this current market, so typically escrow, title insurance, lender's title insurance and owner's title insurance are subject to payment by the convention prevailing in that county and city. Even city transfer tax. So most cities, the city transfer tax is divided 50-50. In San Mateo County, escrow and title are divided 50-50. Santa Clara County here is a seller paid county. Alameda is a buyer paid county. So there are all versions of who shares these expenses. But at the same time, remember that these could be negotiated depending on the market and how that benefits you in terms of the tax benefits. So remember one more thing, that the closing costs, the one-time non-recurring closing costs are tax deductible. So if you pay a high burden of those closing costs, you could write those off in your taxes and you could take that money home. So of course, try to factor in how the closing costs are going to play out, and if that's going to be beneficial, so you could entice the seller by picking the tab for closing costs and claiming that for tax breaks at the end of the year. So that's one way of sweetening the deal. But now let's come to the end of 2025 and see how you can benefit by negotiating with the seller. The market has become fairly slow. It's becoming a buyer's market. So you could, even if the convention says that the buyer is to pay closing cost, you could go and ask for the seller to pay your closing costs today. Not just that, you could even ask for some credits from the lender, because the lenders are getting a lot of benefit owing to the higher interest rate. They can roll their closing costs into your interest rate and give you a better deal on at least the closing costs. So it's not just about knowing the conventions. It's not just about knowing the closing costs. It's not just about knowing how to put this whole thing together. It's about keeping the whole big picture in mind, looking at all these small factors, assembling them and packaging them when writing an offer. An offer is not just filling the check marks. It's a lot of these things that we bring into play and make it work. I hope you're following it. And if you want more details, feel free to comment below. And if you think this article is going to share, this video is going to help anybody, please share it with those friends of yours. Thanks for watching. See you on my next one.